5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to the Follow the Money podcast. I'm Jerry Robinson. It's great to have you here today. Welcome to episode number 489. Today's episode titled The Pivot Beneath the Panic. If you have been paying attention to the markets, you'll know we have just wrapped up one of the most turbulent yet profitable first halves in recent memory. You know, the past 6 months have taken investors on quite a ride. We saw the tariff-driven sell-offs earlier in the year. There were all kinds of anxiety-filled headlines. And then we saw just recently fresh all-time highs in the stock market. We saw Bitcoin touch a fresh record high around 112,000. It's pulled back a bit from that. But it has been pretty wild. You know, having observed these markets now for many, many years, I have to say this first half has been quite interesting. And there's been a lot of panic. But then there was a clear pivot, which was really, an unmistakable shift in market sentiment. Now, we still have a lot of bears out there and a lot of money on the sidelines, which I think bodes well for the second half. So today in our first segment, we're going to unpack what happened in the first half. We're going to discuss some of the standout performers. We'll look at the top ETF performers for the first 6 months of the year. We'll look at the top performing dividend aristocrats. That's one of my favorite lists that we have here at followthemoney.com. We'll also look at just a handful of cryptocurrencies that actually went up in the first 6 months. I think we're going to have a much better second half for crypto. And of course, we'll talk about our own Smartscore 11 strategy, which is a really popular strategy here at Follow the Money for our members. How we'll talk about how that navigated this very volatile landscape and significantly outperformed the broader market. Then in segment 2, we're going to shift gears and we're going to look ahead. So we have expectations of a few Fed rate cuts in the second half. We expect the dollar probably to remain weak. And we see a few sectors that are primed for strength. So I'll share exactly where we see opportunity and risk in the latter half of this year. We've got a lot to cover, so buckle up. Here we go. All right, friends, welcome back. Let's dive right into what unfolded during this wild first half of 2025. And wild is really the only word that does it justice. I mean, we saw incredible volatility, but remarkably, the markets ended on a high note. We'll begin with the big picture here. We'll talk about the S&P 500, which was up around 6% over the first 6 months of the year and notched a record high by the closing of June. We also saw the Nasdaq surge to fresh all-time highs. We also saw Bitcoin really rally, especially in the first half. We did see the cryptocurrency get all the way up to $112,000. It got past that critical $100,000 mark. And we're continuing to see resilience with Bitcoin. Many are looking at it and saying, why haven't we seen a bigger rally? But you've really got to think about what the price is currently for Bitcoin. I mean, we're talking a six-figure priced asset. I mean, I think we have to see this as resilience and also some maturity here in a market that continues to evolve. And it's getting, much broader acceptance. We've seen incredible adoption rates going on with Bitcoin across the institutional space. Retail investors still aggressively buying Bitcoin. We have the ETFs, the best performing, ETFs in history in terms of inflows. So the Bitcoin, ETFs have been a huge success. We see companies adopting Bitcoin in their corporate treasury strategies like MicroStrategy and many, many others. But, all of this positive momentum comes after what we went through back in March and April. You may recall it was just an absolute disaster. The tariff fears rocked the markets. It nearly pushed stocks into a long-term downtrend. We got really close. We didn't get all the way there. But, the stock market was, near bear market territory for sure. But investors who held steady, they saw their stocks recover, at least the majority of stocks recovered in what we'd have to say is record time. If you go back and look at the various V-shaped recoveries we've had, one of the ones that comes to mind is, of course, the 2020 COVID sell-off, which rebounded so quickly. If you blink, you missed it. It's very similar to what we saw back also in the late 2018 Q4 sell-off and that V-shaped recovery. But the market really turned around quickly, recovered those losses very quickly, and now we're not only have recouped all of the lost ground in the S&P 500, the Nasdaq 100, but we're also seeing them move decisively higher. One market that hasn't participated as much in the rally and still isn't back at its former highs is the Russell 2000, but we're beginning to see that turn around too. That's the small cap index here in the United States. We really need small caps to participate in this rally if we really want to see it sustained. But here at followthemoney.com, we have something called our Smartscore 11 strategy, and this has become one of the most popular strategies we offer to our premium members here. It's a proprietary rules-based system that targets stocks with several things. We use our Smartscore system, and some of you are familiar with that. If you're a member, you're certainly familiar, but you've probably heard me talk about it here on the podcast before. It's a stock market ranking system that we created here at followthemoney.com. It's a powerful method to follow the smart money. And what we do is we look for stocks that match the following specific fundamental criteria. We look for stocks that have new institutional buying, that is that institutions are buying the stock. Existing institutional buying, so if it's not just a new stock they're adding, but maybe they're adding more of it, we also push that up higher in the rankings. The stock goes higher in that case in the rankings. We look for high net income. We look for high and stable earnings per share. That's the EPS that we like to look at. The low total liabilities. We don't want to see a bunch of debt in companies. We look for strong corporate insider buying too. That's usually a clue of what's going on internally. And then we also look for high quarterly EPS estimates. Earnings estimates are really, really important. Lynn Zaks really pointed that out back many, many years ago, showing that earnings estimates are, especially revisions, earning estimates revisions are a very important thing to check out. So anyway, so using our Smartscore 11 system, and we call it the Smartscore 11 because it composes 11 stocks. And why is it 11 stocks? Well, we take the 11 sectors in the S&P 500, technology, financials, consumer discretionary, healthcare, all that, and we choose one stock, the top rated, the top ranked stock according to our Smartscore system for each of those sectors. And so for the top stock for the financial sector, we use that for our Smartscore 11 strategy. So it includes the top Smartscore ranked stock from each of the 11 S&P 500 sectors. And we designed this strategy to beat the S&P 500 performance. Because honestly, one of the simplest ways to invest is just simply to buy the S&P 500, right? I mean, you're going to get market-like returns. And you can buy very low fee index funds and just kind of set it and forget it. So if you're going to actually invest in stocks, you want to make sure that you're beating the S&P 500. Otherwise, you're just wasting your time. You could just be getting S&P 500 returns. So how did our Smartscore system do? Well, it did really well. If you look for the first 6 months, the S&P 500 went up a little more than 6%, all in. The Smartscore 11 strategy was up almost 14%. So it more than doubled the S&P 500 during the first 6 months. If you look at the last 3 months, just in quarter two, Q2, the Smartscore 11 was up 20% versus the 10.5% for the S&P 500. And we launched the Smartscore 11 strategy back in January of 2022, one of the toughest times to start any strategy. 2022 was a terrible year for the market, but it was a great year for long-term investors who were smart and savvy and took advantage of the downdraft. But if you go back to that time when we started and launched this strategy, the Smartscore 11 strategy, which is just 11 stocks, and we updated every quarter for our members. In fact, we just did the big quarterly update yesterday for July as we just entered Q3. But the Smartscore 11, since inception, up 113% since January 1st, 2022, versus the S&P 500, which is up 39% during that same time frame. So we've basically almost tripled the performance of the S&P 500 using our Smartscore 11 strategy. So that is working out well. And then we also, of course, that's not our only strategy. We have lots of different strategies. And one of the things that we like to follow are ETFs. Another thing we like to follow are dividend aristocrats. These are companies that have been paying a dividend for at least 25 years, every single year raising the dividend. So it's a pretty tough group to get into right now. In fact, there's only 66 companies in the S&P 500 that actually qualify to be an S&P dividend aristocrat. And then we also like to follow digital assets. There's many other things we do here, but digital assets is another area that we like. So let me just go through and talk about some of the things that we saw. First with the ETFs. We have an ETF leaderboard where we keep our members on the right side of the trend. So you can always come in as a member and see our ETF leaderboard and see what are the top, what are the leading ETFs, not in terms of percentage returns, but instead based upon their trend. This is a powerful system that we've created. And what's nice is that maybe you're a contrarian. You like to look at which ETFs are not trending well right now, because those could be opportunities for those who want to play a contrarian role in their investing. But let's look and see what were the top percentage return performers in our ETF leaderboard. We track 150 of the largest, most important ETFs in that leaderboard. And when we take a look at the top five, we see the number 5 performer in terms of percentage returns was the Global X Silver Miners ETF, SIL. That rose 52% in the first 6 months of this year. Stellar performance, as silver has certainly begun to break out. It's already at a 13, 14-year high, as it's back up at around $37 or so. We see more upside ahead for silver as we go forward, but we certainly saw silver miners kind of perk up in the first half of this year, again, up 52%. The number 4 best performing ETF for the first half was the Global X Greece ETF. Greece has been doing very well this year. In fact, it's still in our, we just put out a note to our members over the weekend about Greece being still in the lead. It's still showing great trend strength here. That one was also up, 52%. The number 3 performing ETF in terms of percentage gains in the first half was the VanEck Gold Miners ETF. That's not a surprise. Ticker symbol GDX. That was up 53.5%. The number 2 best performing ETF may be a surprise to some of you. It's not a surprise to our members because we talked about it quite a bit, but the iShares Poland ETF, ticker symbol EPOL, that was up 57.3% for the first half. And then the number 1 best performing ETF for the first half in our ETF leaderboard was the Junior VanEck Gold Miners ETF. That's GDXJ, ticker symbol. That was up 58%. So, we saw quite a bit of, interesting things happening. You see a lot of a theme here. You see Europe and precious metals, right? And that pretty much sums up what the first half was. Europe was on fire as we saw their interest rates coming down sharply. Many countries in the Eurozone have already, reached their inflation target. And so, we've seen quite a bit of rally there. The U.S. was kind of lagging behind for much of the first half, behind Europe. And of course, precious metals were playing a big role in that first half. Another big story that you might have missed in the first half is the continued slide in the U.S. dollar. The greenback had its worst start to a year since 1973 this year, right? It has continued to slide even as President Trump has backed down from his tariff threats and as the U.S. stock market has recovered from its losses. The U.S. dollar falling around 10% for the first half of the year, right? That is a big move for a major currency like the U.S. dollar. And it's been weighed down, of course, over the concerns about the ballooning U.S. deficit and then the ongoing public disputes between President Trump and Fed Chair Jerome Powell. There's also growing speculation about aggressive interest rate cuts coming later this year. And, historically speaking, when you see weakness in the U.S. dollar, that just tends to boost dollar-denominated assets. And that's exactly what we witnessed. So gold in terms of U.S. dollars, silver, Bitcoin, even international ETFs benefited immensely from the falling dollar. It put upward push upon their prices. Another area that we like to track for our members is what we call dividend aristocrats. Again, these are those S&P 500 companies that have been paying and increasing their dividend every single year for at least 25 years. And so we track those. And as I mentioned, there's only 66 of these stocks. These are usually very high quality companies. And we saw some notable strength here, especially when you consider that the S&P itself delivered about a 6% return over the first half of the year as far as year-to-date gains. And if we look at the top performers in the dividend aristocrats, some of these are pretty boring companies, but they delivered really big gains. The number 5 best performing dividend aristocrat was Franklin Resources, ticker symbol BEN. It was up about 21%. Number 4 was Abbott Labs, ABT. That was up about 21% as well. Cintas, CTAS is the ticker. That was up about 22%. That came in number 3. That's been a really well-run company for many years. Number 2 is an old, kind of a stalwart, IBM. IBM had a really good first half of the year, rising about 36%, right? So that was like a 6x compared to 5 or 6x compared to the S&P 500 for the first half. Then the number 1 best performing aristocrat, is pretty much all of our members know because we talk about it on a regular basis this year, is Cardinal Health, one of the few healthcare companies that really bucked the trend in the first half. CAH up 43%. What a stellar return for a dividend aristocrat. Not only a company that's paying an increasing dividend on an annual basis, but also delivering some really solid capital gains, for investors. And so, we've seen some really interesting things. And then, of course, let's turn to the crypto markets as well, because I want to talk about that briefly, about how the performance was. Very few cryptocurrencies actually went up in the first half of the year, despite all the noise, despite all the excitement, despite all the new regulations, the stablecoin bill, all this stuff, and the talk about a Bitcoin reserve here in the United States. But when we look at the crypto market, we see that there were only a handful of cryptocurrencies that were up for the first 6 months. If you look at the top 100 or so, coming in number 5 was Tron, ticker symbol TRX in the crypto world. That was up around 10% for the first half, right? Number 4 was Bitcoin, the number 4 best performer. Bitcoin up about 15% for the first 6 months. Bitcoin Cash came in number 3. It rose about 18.5%. Maker came in number 2. It was up about 31%. And then the best performing cryptocurrency on our crypto leaderboard was Monero, ticker symbol XMR, in the crypto market. And that year-to-date gain for the first 6 months was about almost 66%. So those were, and aside from just maybe a 1 or 2 others, that was it. Everything else was down for the first half. So I think there's going to be a lot of catch-up happening in the crypto market as we head into the second half of 2025. So as you can see, the first half of 2025 was anything but dull, whether you're focused upon stocks or ETFs or precious metals or digital assets. Opportunities are abounding here. And if you're interested, by the way, in accessing our full Smartscore 11 list of stocks we just released, or the ETF leaderboard, or the crypto leaderboard, or our aristocrat leaderboard, and where we keep our folks, up to date on all of these different things, helping you keep your finger on the pulse of the market, you can easily find all of this by becoming a member here at followthemoney.com or in our investing club. So that wraps up the whirlwind first half. But what about the next half? Well, after this quick break, I'll share exactly what we're watching closely for the third quarter and into the last few months of the year, and why I believe the second half might surprise even the most seasoned investors. Stay tuned for that.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back. Now that we've reviewed the incredible price action from the first half of the year, let's pivot our gaze forward. What's next for the markets in the second half of 2025? Well, I wish I had a crystal ball, but I don't. And if I did, it would be broken, right? So there's no way really to know exactly what's ahead, but I'm going to give you my best guess. I'm going to tell you what I'm looking at, what I'm focused upon, and I'll just summarize my outlook pretty clearly. I'm bullish, but I'm not blindly bullish. Let me say it that way. I see a lot of opportunity, and I'm fully aware that we're navigating a lot of risks here. But I believe the second half is going to be shaped by a few things. First, falling interest rates. It's been very clear that the Trump administration wants lower interest rates. Why? Because that stokes the market. It unleashes the animal spirits, and it's good for politicians who are in power. They want to see lower interest rates. Europe is enjoying lower interest rates right now. We've seen their stock markets on fire, as we talked about for the first half. And that's what we are expecting to see here in the United States. We've already seen, in fact, the Federal Reserve hint at a rate cut for July. And I think we're going to get that rate cut in July. And I think we're going to get 2 more rate cuts over the coming months before the end of the year. So I believe the second half is going to be shaped by falling interest rates. I expect at least 3 rate cuts from the Federal Reserve in the back half of the year. And inflation is, trending toward the Fed's target, and Chairman Powell has clearly indicated that he has a flexible stance. Now, as you know, as I mentioned, lower interest rates typically act like rocket fuel for risk assets, and we're positioned accordingly. And I think that it, would be a very smart idea to be ready for that. I think you're going to see quite a few things rally. We'll talk about that in just a minute. We also believe that we're going to see tech-led growth again in the second half, although we are going to see it broaden out. Maybe some small caps are going to participate in the broader rally. And I think we're going to see continued strength in the digital asset space and hard assets as well. Another key tailwind that I'm going to be watching closely is the U.S. dollar, because if the greenback continues its retreat, which is very likely considering that the Fed is, may cut interest rates up to 3 times as we expect in the second half, then that could provide even greater support for precious metals, for digital assets, for emerging market ETFs, and certainly for, just the general stock market here in the United States. And the weaker dollar story is not just driven by tariffs. It's not just driven by, political dynamics between Trump and Powell and whether that we have an independent Fed or not. It really reflects the ongoing deficit concerns that we have in this country. We have a $37 trillion national debt. We have a new bill that's coming through the Senate and now potentially the House pretty soon that President Trump wants passed by July 4th. And that bill, is going to add a lot of debt as well. So there's a lot of concern, and that's putting, a pressure on the U.S. dollar. And if that dollar weakness persists, and I think it's very likely to, we'll probably have a few rebounds along the way, but I think it's, mostly going lower here. It's very likely we'll see sustained momentum in these, across the board in risk assets. And so with that backdrop, let me talk about a few market themes that we're keen on, particularly for the third quarter. First up is technology. Tech remains the backbone of this momentum-driven market. Tech is what I largely focus on in my own stock investment portfolio. It's just a market that I am much more aware of, and one that I'm much more focused upon than others. And I think the optimism around artificial intelligence, obviously was pretty extreme whenever we first heard about ChatGPT and, the AI chatbots that are available. But there's so much ahead. I mean, there's so much ahead in terms of what artificial intelligence means for automobiles and what it means for humanoid robots. In fact, there's a brand new ETF, a couple actually, that are targeting these humanoid robots, which I think is going to be a massive market. I mean, really, really big. So there's going to be, a lot there. I wouldn't count the technology sector out just because valuations feel elevated. I think we're going to continue to see this rally. And of course, one of the simplest ways to get exposure to that market is through the Nasdaq 100. That's an ETF. I actually invest in the Invesco, Nasdaq 100 ETF. That's been a long-term, buy for me for many, many years. It's just one of the areas that I really like to focus on. I also like to trade around that market. But regardless, the Nasdaq 100, one of the simplest ways to get index fund exposure to the broader technology market here in the U.S. Another area that we expect to see profits in, further profits than what we've already seen, is the financial sector. This sector has really been under-owned and quite frankly overlooked, but we are starting to see some early signs of life and renewed interest. Lower interest rates are obviously going to be beneficial for many financial companies. It's going to drive more loan growth and all of this. And so valuations here are compelling compared to some of the other sectors. So it does have my eye. We own a few financial stocks in our long-term portfolio. I'm not really looking to add more, but it may be an opportunity for those who don't own financial stocks to maybe take a look, or to maybe trade around that in that market, that sector. Also, one of the things that I recently turned bullish on back in May was platinum, physical platinum. Obviously, precious metals have been doing great. Gold's up great this year. Silver's doing great. But platinum, which is much more rare, by the way, than gold in terms of above ground inventory and even annual production, platinum is a very, very rare metal. And I bought some more from Tom Cloud recently because we had a meaningful breakout in platinum that I haven't seen. I've been waiting for well over a decade for this breakout. I think there's going to be much more upside ahead for platinum over the next few years. I think we might be in a very bullish cycle for platinum, and I think for precious metals in general. Obviously, gold's got a little bit ahead of itself. It's pretty overstretched right now, technically speaking. I still think we're going higher with gold, but some consolidation makes sense here. I think there's more upside for silver, and certainly more upside for platinum, in my opinion. We're seeing institutional money continue to flow strongly into these types of hard assets. We got investor confidence that's pretty elevated here as people are coming to recognize their long-term value, and I think that's positive. And then finally, digital assets. The regulatory environment has really shifted dramatically towards a more crypto-friendly stance, and that's really going to serve as, I think, a major tailwind for Bitcoin, Ethereum, and several other leading cryptocurrencies. Institutional adoption is just really accelerating, and we're looking for a breakout above 112 on Bitcoin. I think it'll come sooner rather than later. We've been churning now for a bit below that former all-time high of 112,000. I think we're going to see this rally take on some legs, and we should see a breakout soon. I'm also very, very bullish on Ethereum. I don't know if you heard, but recently Tom Lee, a famous Wall Street strategist, is actually targeting Ethereum now, Ether, as a treasury reserve asset. He's been installed as a CEO of a company, and he's going to be leading that company with Ethereum strategy, a treasury strategy. So, I mean, you already have corporations buying Bitcoin to put on their balance sheets. Now Ethereum is getting similar, and I thought it was just a matter of time, so I'm not too surprised to see that. So now, obviously, I'm very bullish. I think we're going to see Bitcoin and Ethereum and several others do very, very well in this latter half. I mean, really well. But let's balance out some of this optimism because we do have some risks, right? We have obviously tariff concerns. They're likely to resurface, especially as July brings renewed deadlines. There's a July 9th deadline, I believe. And then there's obviously potential conflicts around these tariff concerns. Any escalation here could pressure the markets again, although it seems like the markets have kind of begun to look past the tariff. So unless there's anything really major, it's difficult to imagine the market reacting the way that it did the first time to Liberation Day earlier this year. Middle East volatility remains another wild card, particularly the tensions between Israel and Iran. Any flare-ups there could quickly ripple through the markets. We pray for peace in that region of the world. We pray for peace everywhere, but let's see some peace between Israel and Iran, Israel and Gaza. This is just horrific. What's happening over in that part of the world? We want to see peace. That volatility, though, remains a wild card, so we have to keep one eye there. And then, mega cap tech valuations are another factor. Despite my bullish outlook on tech, I think it's crucial to acknowledge that we are seeing some elevated valuations that could pose downside risk if earnings or growth disappoint. I don't really think that's going to be a major problem here as we head into the latter end of the year. I mean, quite frankly, there's a ton of money on the sidelines, $7 trillion sitting in money market funds right now. And interest rates are coming down. So where's that money going to go? It's going to try to find a better home, right? So we think there's going to be quite a bit of fresh investment flows coming in the second half of the year, especially as interest rates come down. People will move out of bonds. They'll move out of money markets and CDs and get back into the market, especially now with the S&P and the Nasdaq back at new all-time highs. That starts to create that FOMO, or that fear of missing out. And then I think another area to watch in the second half is the speculation around Trump's potential Fed appointment, Federal Reserve chair appointment. That could impact rate expectations and market sentiment. Fed leadership uncertainty tends to weigh on the market, and that just adds another layer of complexity. So we'll be watching that pretty closely. We have some opinions about who we think Trump may replace. I think it's pretty clear who he's going to replace Jerome Powell with, but I'll reserve my comments on that. I might talk about that soon on this broadcast. But anyway, throughout all of this, we're going to continue relying upon our strategies that we have here at followthemoney.com, like our Smartscore 11 strategy. That's been, leading the way since 2022. It's been beating the S&P 500 by a factor of about 3x, and it just continues to outperform. We're also going to be closely monitoring our ETF leaderboard for early signs of new market leadership. It's one of the best ways to discover new breakout opportunities, similar to what we saw with Poland and Greece and Spain and miners during the first half. And my final thought for today is simply this, that there is opportunity, but it's going to be selective, right? So you're going to have to stay focused and stay informed, and you don't want to chase the rally. The second half, I think, is set to reward those who are positioned smartly, not just blind optimism. So I want to encourage you to be wise in this environment. Even though we expect more upside ahead, we also encourage you to be wise stewards of the money that you have been given to steward. So with that said, that brings us to the end of this segment. I'll share some of my concluding thoughts and a final word on the other side of this break. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. You know, we've covered everything from the turbulence created by the tariffs earlier this year to the all-time highs that we saw in the markets here at the end of the second quarter. And so the first half of 2025 was truly a whirlwind. And as we've discussed today, the third quarter is already shaping up to be equally consequential. And I really appreciate the ability to navigate these waters together with you, helping you stay informed and well-positioned. That's absolutely crucial. If you're not yet a member of followthemoney.com, part of our investing club, I can't think of a better time to join. Inside our membership, you'll gain immediate access to our Smartscore 11 strategy, which is those 11 stocks that we handpick and put out each and every quarter for our members that are beating the market by about 3x. You have access to our ETF leaderboard, daily swing trading ideas that are handpicked by me and put out with my comments. You also have access to our weekly coaching calls where you're able to learn how to become a better trader, a better investor. And you also unlock access to all of our courses on swing trading and on day trading and all the different courses we've done over the years you have access to. Just simply head over to followthemoney.com/join, and there you can see all of the different plans and prices. We'd love to have you on board, helping you turn this market uncertainty into informed trading and investing confidence. So thanks for tuning in today. I greatly appreciate your time, your trust, and your partnership on this financial journey. Before we end, let me leave you with this final word, this time by Jesse Livermore, one of the famed traders of during the Great Depression, when he said, "Markets are never wrong, but opinions often are." That's so true, friends. And that's why we teach you over and over again that it's not enough just to follow the headlines. You really need to follow the money. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.